Hello everyone, welcome to the Kai's Family of Services July update. As we kick off the third quarter, here are some updates from our FOS leaders.
Hi, Craig Garcia with Capital Partners Mortgage. This month I wanted to talk to you about a common misconception regarding the Federal Reserve and what happens when they cut rates. So the Federal Reserve, their goal is to help foster steady growth in the economy with low inflation. And so the tool that they have to do that is by manipulating short-term interest rates. Technically, they manipulate the rate that banks use to borrow from one another overnight. If they feel like the economy is heating up too fast, they will raise rates to kind of slow the economy down. And if they feel like the economy is slowing down, they can lower rates to help stimulate more growth. So when they make a rate cut, what changes immediately are things that are adjustable rate in nature. So like a line of credit on your house could change right away. Your credit card debt, those rates could change right away. Common misconception is that long-term 30-year, 15-year fixed mortgage rates change right away, and that's just really not the case. So longer-term debt, 30-year fixed mortgages, 15-year fixed mortgages, those rates are set by people who are buying and selling bonds in the financial market, and those rates change all the time. And so usually what's happening is if the market feels like the economy is getting better, then rates will typically come up. If the market starts feeling like the economy could be getting worse and the Fed could lower rates, then you could see rates come down. And so the common mistake is that people will say, okay, they're looking to get a mortgage or they're looking to buy a house, and they go, but I'm going to wait because I hear the Fed is going to be lowering rates. And then what happens is the Fed does make a rate cut, and the next day or the same day, 30-year fixed rate mortgage rates go up. And that happens more often than you might think. And it could be because based on what the Fed said when they made a rate cut, the market believes, hey, they're thinking that the economy is actually getting better. Hey, maybe they won't be cutting rates in the future. Maybe they're done cutting rates. So the Fed rate cut could lead to higher 30-year fixed rate mortgage rates. Doesn't mean that that's the case, but it could happen. And so the mistake is, hey, if rates are good right now, but you're anticipating that you're going to be even better because of a Fed rate cut, that Fed rate cut may not lead to a lower mortgage rate for you at the time that it happens. So with rates being as low as they are right now, and they've been coming down, if you're comfortable with a rate, you're comfortable with a payment, I would say take advantage of that now, and waiting on a future Fed rate cut could be a mistake. We don't know until it happens, but that does not mean that the rate is going to change on your loan. Anyway, hope you have a great month, and we'll talk to you next month. Bye-bye.
Hello. Many times over the last few years, I've talked to you guys about increasing rates in a tightening market. I wish that I hadn't, so that now when I speak to you and I tell you the same thing, you'll believe me even more and take the significance. Because quite frankly, in all the years that I've been doing this, right now we're in the tightest market that I've been a witness of. If you have a home 30 years old in the Dade, Broward, or Palm Beach area, there are now 2, maybe 3 carriers in the entire state that will offer a product for that home. Because of lack of competition, the pricing is continuing to increase. If you're looking for a home for your client and you want to have the insurance rates be as competitive as possible, the best home is a home since 2002 with a roof that is 10 years or less. As you start to go through and you have electrical issues, plumbing issues, roofing issues, you start to diminish the amount of carriers that will take that home. So it is very important as you're looking at properties in the next few months that you reach out to us very early so we can help set the expectation for your client and what the cost of that insurance may be. Thank you, and we'll see you next month.
Hello there. When it comes to title insurance, most people know they get it when they purchase a home. Sometimes the buyer pays for it, and sometimes the seller pays for it. But what is it really, and what does it cover? I'd like to help bring some clarity on this. First, as a buyer, if you are obtaining financing for your home purchase, your lender is sure to require a lender's title insurance policy. This policy protects the bank or other lending institution for as long as they maintain an interest in the property, typically until the mortgage is paid off. And why, if you have a lender's policy, would you want to pay for an owner's title insurance policy? Well, it's important to note that while the bank will require this policy, a lender's title insurance policy only protects them, not you. Therefore, it is a wise choice for you as a homebuyer to purchase an owner's policy, a policy that will protect your rights as the homeowner for as long as you or your heirs own the property. Protect me against what, you ask? Well, although a thorough title search and examination is done prior to the issuance of these policies, title insurance may provide you with protection from title problems discovered after you purchase your home. These problems can include errors in public records, undiscovered liens, fraudulent or illegal deeds, unknown easements, boundary or survey disputes, and undiscovered wills, just to name a few. These and other issues are usually covered by an owner's title insurance policy. It is a one-time fee paid at closing for a lifetime of peace of mind. I'm Marlene Rodriguez with Home Partners Title. Stay protected and make it a great day.
Hi, Benji Jean with Kai's Property Management. Here to speak with you about the heavy leasing season and identity theft. As we all know, in the summer months, we see a tremendous amount of activity in the leasing market. Whether families are looking to move to better school districts, or as we've all seen, a large number of people now moving to Florida. With this comes fraud. What we've also seen is an increase in the number of fraudulent pay stubs being produced, as well as the number of fraudulent identifications being produced. The last thing we want is for you to move in a tenant into a property for your owner, and that is not the person that you think you're moving in. So, what can we do? The first thing is you want to verify the pay stubs. You may call the employer and verify the income and that person works there. The second thing you might do is you might verify their identification card. You can do this by going online. One other tool is myrentalscreening.com, where we can help you verify the identity as well. Thank you and have a wonderful month.
As always, thank you to our leaders for the great updates. We hope you continue to have a fantastic summer. We wish you a safe and a happy 4th of July, and we will see you guys next month.